10 tips for successful long-term investing. In today's fast-paced world, the allure of quick gains and overnight success can often overshadow the importance of long-term investing. While the allure of get-rich-quick schemes may be tempting, the true path to financial growth lies in the steady and consistent approach of long-term investing. Whether you're a seasoned investor or just dipping your toes into the world of finance, understanding the keys to successful long-term investing is crucial for building a robust portfolio. In this video, we will unveil 10 indispensable tips that will help you navigate the complex landscape of long-term investing and set you on the path to financial prosperity. From cultivating patience and embracing diversification to staying informed and being mindful of your emotions, these principles will empower you to make wise investment decisions and weather the inevitable ups and downs of the market. So, if you're ready to unlock the secrets of successful long-term investing, let's delve into these invaluable tips that will guide you toward a secure and prosperous financial future. But before we move on with the video, support the channel by liking this video and subscribing to this channel for future updates. Number 10. Understanding successful long-term investing. Ride a winner. Peter Lynch famously spoke of investments that increased tenfold in value. He attributed his success to a small number of these stocks in his portfolio. But this required the discipline of hanging on to stocks, even after they've increased by many multiples, if he thought there was still significant upside potential. The takeaway: avoid clinging to arbitrary rules and consider a stock on its own merits. Number 9. Sell a loser. There is no guarantee that a stock will rebound after a protracted decline, and it's important to be realistic about the prospect of poorly performing investments. And even though acknowledging losing stocks can psychologically signal failure, there is no shame recognizing mistakes and selling off investments to stem further loss. In both scenarios, it's critical to judge companies on their merits to determine whether a price justifies future potential. Number 8. Don't sweat the small stuff. Rather than panic over an investment's short-term movements, it's better to track its big-picture trajectory. Have confidence in an investment's larger story, and don't be swayed by short-term volatility. Don't overemphasize the few cents difference you might save from using a limit versus market order. Sure, active traders use minute-to-minute fluctuations to lock in gains, but long-term investors succeed based on periods lasting years or more. Number 7. Don't chase a hot tip. While it can be tempting to chase after a hot stock tip that promises quick gains, relying solely on such information can be a risky and unreliable approach to long-term investing. Instead, successful long-term investing requires conducting thorough research and analysis to make informed decisions about where to invest your hard-earned money. To make sound investment decisions, it's crucial to understand the company's fundamentals, including its business model, financial health, competitive landscape, and growth prospects. Doing your analysis allows you to gain a deeper understanding of the company and evaluate its long-term potential. Relying solely on a stock tip without evaluating these risks can lead to unexpected losses. Conducting your research and analysis instills confidence in your investment decisions. Successful long-term investing involves looking beyond short-term gains and focusing on the company's growth potential over an extended period. By conducting your analysis, you can evaluate the company's competitive advantages, market positioning, and potential for sustained growth. This long-term perspective helps you make investment decisions based on the company's underlying fundamentals rather than short-term market fluctuations. Remember, while stock tips may occasionally pan out, long-term investment success is built on a foundation of thorough research and analysis. By taking the time to understand the company, assess the risks, and align your investments with your goals, you can make informed decisions that have a higher probability of success. Number 6. Pick a strategy and stick with it. There are many ways to pick stocks, and it's important to stick with a single philosophy. Vacillating between different approaches effectively makes you a market timer, which is dangerous territory. Consider how noted investor Warren Buffett stuck to his value-oriented strategy and steered clear of the dot-com boom of the late 90s, consequently avoiding major losses when tech startups crashed. Number 5. Don't overemphasize the price-to-earnings ratio. Investors often place great importance on price-earnings ratios, but placing too much emphasis on a single metric is ill-advised. Price-to-earnings ratios are best used in conjunction with other analytical processes. Therefore, a low price-to-earnings ratio doesn't necessarily mean a security is undervalued, nor does a high ratio necessarily mean a company is overvalued. Number 4. Focus on the future and keep a long-term perspective. Investing requires making informed decisions based on things that have yet to happen. Past data can indicate things to come, but it's never guaranteed. In his 1989 book, One Up on Wall Street, Peter Lynch stated, "If I'd bothered to ask myself, how can this stock possibly go higher? I would never have bought Subaru after it already had gone up 20-fold. But I checked the fundamentals, realized that Subaru was still cheap, bought the stock, and made 7-fold after that." 2. It's important to invest based on future potential versus past performance. While large short-term profits can often entice market neophytes, long-term investing is essential to greater success. And while active trading, short-term trading can make money, this involves greater risk than buy and hold strategies. Number 3. Be open-minded. Many great companies are household names, but many good investments lack brand awareness. Furthermore, thousands of smaller companies have the potential to become the blue-chip names of tomorrow. Small-cap stocks have historically shown greater returns than their large-cap counterparts. From 1926 to 2017, small-cap stocks in the U.S. returned an average of 12.1%, while the Standard & Poor's 500 index, S&P 500, returned 10.2%. This is not to suggest that you should devote your entire portfolio to small-cap stocks, but there are many great companies beyond those in the Dow Jones Industrial Average, DJIA. Number 2. Resist the lure of penny stocks. Some mistakenly believe there's less to lose with low-priced stocks, but whether a $5 stock plunges to $0 or a $75 stock does the same, you've lost 100% of your initial investment, so both stocks carry similar downside risks. Penny stocks are likely riskier than higher-priced stocks because they tend to be less regulated and often see much more volatility. Number 1. Be concerned about taxes, but don't worry. Putting taxes above all else can cause investors to make misguided decisions. While tax implications are important, they are secondary to investing and securely growing your money. While you should strive to minimize tax liability, achieving high returns is the primary goal. Successful long-term investing is a journey that requires discipline, patience, and a comprehensive understanding of the market. By embracing the power of patience, diversifying your portfolio, setting clear goals, staying informed, and avoiding emotional decision-making, you can navigate the ups and downs of the market and pave the way for long-term financial growth. Remember, the key is to focus on the bigger picture, allowing time and compound interest to work in your favor. So go forth with confidence, armed with these 10 tips, and embark on a path toward a prosperous and secure financial future. That's it from this video. Let us know what you think about this video in the comment section below. If you enjoyed this video, please like it and also subscribe to our channel. Thank you.